Ladies and gentlemen, good day and welcome to Capital Small Finance Bank Limited Q4 FY2024 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of this company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sarvajit Samra, Managing Director and CEO of Capital Small Finance Bank. Thank you and over to you, sir.
Thank you, Muskan. Good morning, everyone. Thank you all for joining Capital Small Finance Bank's inaugural earnings call. We are extremely grateful to all the support we received from our shareholders, including our anchor investors who believed in our business philosophy throughout our journey from an unlisted entity to a listed entity. Since this is our first earnings call after our IPO, we would like to take the opportunity to provide a concise overview of our history, our vision, our business segments, and future trajectory, along with discussing our financial and business metrics. Our investor presentation and financial statements are readily available on our website and the stock exchanges for your reference, and I hope everyone got a chance to go through the same. Joining me in the call are my colleagues, Munish Jain, who is Executive Director, Aseem Mahajan, CFO, Raghav Agarwal, Chief Risk Officer, Sahil Vijay, who is Head Treasury and Investor Relations, Bharti Bhuguta, who is part of Investor Relations team, along with team of SGA, who are our Investor Relations advisor. Let me provide a brief overview of the bank and the industry landscape, following which Munish will provide a detailed overview on business performance and financials. Capital Small Finance Bank commenced operation as India's first small finance bank on April 24, 2016, following its conversion from a local area bank. Prior to this transformation, we operated as largest local area bank for 16 years, serving 5 districts in the state of Punjab. Starting with 47 branches at the time of conversion, we have since expanded to 177 branches across 5 states of North India, that is Punjab, Haryana, Rajasthan, Delhi, Himachal Pradesh, including the Union Territory of Chandigarh. Our business focus on the middle income group customer segment, having an average income ranging from 4 lakhs to 50 lakhs. Our objective is to establish ourselves as the primary banker for this demographic. We do not serve either the below poverty line customer segment or the super high net worth individuals. We maintain a granular approach to both sides of our balance sheet, boasting a diversified loan book with 0 direct microfinance exposure. Our loan portfolio is nearly 100% secured with average ticket size of rupees 14.2 lakhs. Likewise, our liability franchise is heavily retail oriented, with retail deposit comprising 92.9% of the total deposit and maintaining a consistent CASA ratio of above 38%. Our savings bank's interest is 3.5%. Driven by a customer-centric approach, we aspire to be the primary banker of our target segment. Our comprehensive suite of loan, deposit and third-party products are available through a single window service, even at our remote rural branches. The bank operates on a branch-led business model with a significant presence in semi-urban and rural areas. The bank employs contiguous branch expansion strategy by first combing and then carpeting, that is, first entering into major business growth areas of new geographies by offering loan products first, and then expanding our deep presence in the close-by territories. Our emphasis is more on deposits and cross-selling of other products after having built a strong customer relationship. We believe that our experience of operating as a local area bank for over 16 years provide us a competitive edge with respect to our understanding on growing our customer base, which currently stands at more than 7,41,000 customers. The bank has successfully raised capital amounting to rupees 523 crores, including a fresh issue of 450 crores through a well-received IPO, which listed on February 14, 2024. With this growth capital, we are confident to march ahead sustainably, seizing the abundant opportunities that lie ahead. Talking about the economy, India is one of the fastest growing economies in the world, having clocked 5.9 average gross domestic product growth over the last decade, that is between the years 2015 to 2024. Growth in India is projected to remain strong at 6.9% in the financial year 25. India is aspiring to reach high middle income group status over the coming period. Amidst this economic landscape, your bank is strategically positioned to capitalize on the rise of the middle income group segment, we being a middle income group banker. In April 2024, RBI came out with guidelines for voluntary transition of small finance banks to universal banks, subject to small finance banks fulfilling various eligibility criteria. We feel this is an important breakthrough in the evolution of Indian banking sector. We are on the track to achieve the necessary parameters towards a universal banking license and hope to apply for the same in next couple of years. With a strong Indian macroeconomic scenario, rising middle income group, and strong fundamentals and growth levers available to the bank, we are highly confident of a fast-paced sustainable growth in the current growth cycle. The bank has been consistent compounder for all its stakeholders. We need the continuous trust and backing of all the stakeholders, especially the esteemed investors, to unleash our true growth potential. Thank you. I will now hand it over to Manish, who will share a detailed overview of our business performance and financials.
Thank you, Mr. Chandra, and a warm welcome to all of you. Now let me share with you the highlights for the financial year 24 and Q4 FY24. Our gross advances stood at 6160 crore as on March 31, registering 5-year CAGR of 19%, Q&Q growth of 8%, and YOY growth of 12%. We are a secured lender with 99.9% being secured book. With 86% plus book, we have a collateralized with the immovable property or bank's own FDRs. We are a middle income group based lender, and our endeavor is to be the primary banker of the borrower. The portfolio ATS is 14.2 lakhs, and 67% of our portfolio is with the clients having an exposure up to 25 lakhs. We are well diversified, with each segment witnessed multiple cycles. The portfolio comprised of 37% agriculture, 26% mortgage, and 19% MSME and trading book. Our disbursement for FY24 were 2,068 crores, consisting of around 27% to agriculture, 24-25% to mortgage, 22-23% to MSME and trading segment. Post the capital infusion in February 2024, the disbursement has accelerated, and Q4 FY24 disbursement were 675 odd crores, which is 76% growth over Q3 FY24. Our experience being in a lending business for more than 2 decades help us in putting in place streamlined credit assessment processes and risk management practices. We have industry-leading asset quality with GNPA and NNPA of 2.8% and 1.4% respectively. Our NNPA is stable around the same level over the last 3 years. It is worth mentioning that we have near zero write-off and nil NPA sell-off since inception, demonstrating our ability to recover. Our focus is on collection and resolutions, even for the sticky loans. Our slippage ratio for FY24 stood at 2.4 with the upgrade and recovery ratio of 2.1%. And further, our credit cost historically remained range bound even during the COVID period. Moving towards the liability side, we believe our liabilities are one of our biggest assets. The liability mix is positively skewed towards deposit, with on liability side of the balance sheet, 80% of that is in the shape of deposits, 13% being the shareholder fund. So our liability is purely skewed towards the deposit. and retail deposit constituting 93% of the deposit with a CASA of 38% plus. It is worth mentioning that over interest rate on saving bank account is 3.5%. The deposits stood at 78 odd crores as in March 31, registering a 5-year CAGR of 15% and YOY growth of 14%. We have consciously calibrated deposit growth owing to the low CD ratio and high leverage prior to the IPO. We strongly believe that we have the ability to quickly ramp up the deposit mobilization to support our credit growth. Talking about profitability, we have demonstrated consistent improvement in our return metrics, and our ROTA for FY24 is at 1.3, which is 2.5x over FY19, and our ROE is 14.6, which is 1.8x over FY19. The OPEX to the average profit assets for FY24 stood at 2.95 against 2.9 for FY23, and cost to income ratio for the year is 62.5%. The NIM for the year 3.9, and our non-interest income is 0.8 against 0.6 a year before. The PAT for the year is 112 odd crores with a 5-year CAGR of 42 and 0-year growth of 19% with and a Q&Q growth of 16%. The drivers for the PAT drivers includes improving the CD ratio, which is helping us in accelerating the NIM. Operating leverage benefit coming from our continued increase in the proportion of the mature branches and low credit cost. Our focus on retail deposit results in one of the lowest cost of funds and our cost of deposits, which stood at 5.8% and 5.6% respectively. Our CD ratio has improved by 11.5 percentage points since to FY21, and our average CD ratio for FY24 stood at 79%. The funds from the IPO has strengthened our capital adequacy ratio, which is now 27.4 in FY24. The LCR for FY24 was 248% plus with the average CD ratio of 79%, which are giving us a growth lever for the loan growth. Going forward, we intend to expand our branch outreach by scaling up our new branch opening, by expanding outreach in the contiguous states coupled with deep penetration in the existing markets. Our endeavor is to organically grow our secured loan book with 22 to 24% target growth rate, targeting MSME, trading, mortgage and agriculture segment. We intend to capitalize on the anticipated tailwind in the middle income group segment. We target ROTA expansion to 1.4% for FY25 and continuous ROTA expansion going forward. Our focus on strengthening operational and profitability metrics shall be driven by improving CD ratio, which consequently will make a NIM expansion, optimizing our operating cost and improving share of the fee income. This is all from my side, and I request Muskan to begin with the Q&A.
Thank you very much. We will now begin the question and answer session. Participants present on the audio bridge who wish to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Ladies and gentlemen, we'll wait for the moment while the question queue assembles. First question is from the line of Chinmay from Prescient Capital. Please go ahead.
Good morning, sir. Thank you for taking my questions. Firstly, could you highlight this 430 odd crores of increase in the gross advances? How much was from the newer geographies and how much was from our old geography?
If I just give you a split about our advance growth. Advance growth in FY2023 consisting of 85%, book consisting of 85.19% from Punjab and 14.81% from out of Punjab. As on March 31, 2024, the ratio being Punjab number is being moving is now 82.6 and the out of Punjab being 17.4. So we are seeing an improvement in out of Punjab share to the total advance number. And if we look this number from a split perspective, our composition, which is consisting of agriculture of 37%, which was 39% a year back, mortgage is 26%, which was 26% a year back, MSME is 19, which was around 19-20% a year back, corporate oblique NBFC lending is 9%, which was 8% in a year back, and consumption lending being 8%, which was 7% a year back. So accordingly, growth is evenly spread in all the segments.
Got it, sir. And secondly, in FY24, the write-offs have gone up from 0.1 CR in the previous financial year to 0.4 CR. Could you throw some light on which portfolios were these from, and was there any lumpiness in the loans?
Just to draw the attention, the total write-off value for the cumulative year is 40 lakh rupees or 4 million against a portfolio of around 6150 odd crores. So this is not any lumpiness of the loan. This may be one of the standalone, one or couple of the standalone cases where there are certain different regions like that of the borrower and guarantor. So it is not linked with any particular portfolio segment, and neither the value is significant. It is completely insignificant value, being 4 million on a total portfolio of around 6200 odd crore rupees.
Understood, sir. And could you provide the OPEX guidance for FY25?
So we typically look to expand our branch outreach. So typically we look to scale up our branch outreach. And along with this, we believe the matured branch mix will continue to improve as we are going forward. So we believe this particular benefit on one side will be offset by the increased branch expense. So we believe our OPEX ratio going forward will remain around the same level as is in the current fiscal.
Understood, sir. Understood. And lastly, could you talk about our PCR? What has the trajectory been in the last couple of years, and what is the number right now?
So our provision coverage ratio for the current period is around 50%, and we are maintaining almost similar type of PCR over the period. And now if we slice it further, so we are maintaining a PCR in excess of what is required under the law to ensure that the rightful money is being provided for on the PCR. So our PCR for the current fiscal as well as over the last period were around 50% plus.
Got it, sir. Got it. I'll join back the queue for any more questions. Thank you.
Thank you. Thank you.
Thank you. The next question is from the line of Anand Mundra from Temple Capital. Please go ahead.
Hello. Good morning, sir. Thank you for the opportunity. Sir, I'm just referring to slide 7 of the presentation where the asset quality has been given. So if I see from FY19 to FY24, the gross NP has been consistently going up. So can you explain what is happening exactly here? Because our credit cost is very low, but gross NP is going up.
We typically follow a philosophy of recovery. Our emphasis is on collection and resolution even for the sticky loans. So if you look into this number, so instead of going ahead with the write-off or that particular thing, we typically follow the recovery path. Even if you look into the current fiscal, we do have a slippage of 2.4 and with the upgrade ratio of 2.1. So typically almost similar amount we are able to upgrade of the last period. So from FY19 to FY22, there is some increase in this particular ratio because we follow the recovery path, because from FY20 to FY22, there was some regulatory restrictions for enforcing of certain securities that the SARFAESI, etc., was being postponed for some period. So that's why there is some increase, but we will strongly believe all these assets are recoverable. So instead of following the cleansing route, we keep it in our book, and so this GNPA got a bit swollen during that particular period, FY20 to FY22. But we are continuously ensuring that the recoveries keep on happening and we keep on moving in the right direction.
Okay, and so the credit cost that you've shown as of 0.1%, that is net of recoveries then, correct?
Credit cost of 0.1, which includes write-off provisions both for the standard and the NPA.
That's it. It does not include any recoveries that we are doing or for any return of assets or I mean, because that generally goes in the other end.
Return of it included in this. The complete thing, which is the charge we are taking to the P&L regarding the loan, is being part of it.
Okay, so the recovery is also a part of it, correct?
No, recovery is typically, that is not a credit cost. Recovery is really impact on the GNPA. Credit cost is typically the write-off or the provision which we need to create against the advance book, including the technical.
Okay. Got it. And sir, if I see MSME loans are having a higher NPA, yet we have lower yields on that. So what explains that?
So typically the MSME loan book, if you look into this MSME loan book, the NPA number are on a declining trend, which was 3.14 in the last year is 2.73. These are typically during the COVID period, which we have that particular some pain come in that area from a certain very few number of tax cases. So which is already being in the resolution. So that is about that particular period. But the interest yield are typically market driven. We being a lender for the prime property based and the financial document based lender. So accordingly, the lending yields are aligned as per the market conditions.
Okay, sir. And sir, what are the things that we have to improve ROA?
I missed what your question, please. You can please repeat again.
So what are the levers that we have to improve our ROA, and if you can explain some of the strategies that we will adopt to manage these levers?
Surely. We typically have the 3 levers for the ROTA expansion. The first being the NIM expansion. That is we are looking to increase our NIMs. We are presently sitting at 79% average CD ratio for FY24 with a capital adequacy ratio of 27% plus with the LCR of 248%, which giving us an opportunity to expand the CD ratio. So with each acceleration in the CD ratio, we believe the NIM will be keep on happening. As per our internal calculation, with 100 basis points increase in the average CD ratio, there will be an expansion in the NIM of 5 basis points. So that is the first lever we are looking forward. We look forward to increase the CD ratio from the 79% presently. The second lever which is available here is increasing the non-interest income component, which is presently 0.8% if we calculate it on our average asset basis. Given our customer base, given our increasing in the matured branch count, our primary banking relationship, our saving account ATS, which is 42,000 rupees, expanding loan book, we believe there is enough opportunity to expand it further. And third lever which is available is operating leverage. As we discussed earlier, we're looking up to scale up with the scale and increase in the proportion of the matured branches. So this will be another lever which will be available. So we believe there are the 3 side levers available for our ROTA expansion as we move ahead.
So just to follow up on this, the credit deposit ratio right now is 79%. So at what level can we take this up to?
So we typically look for the medium term range to take it mid to the high 80s.
Okay. And similar on the non-interest based income, I mean, how much do we want to take that up to in the medium term?
So typically non-interest income, yes, ideally we want to take it to the very good levels, obviously. So presently we are 0.8, but we believe the opportunity to grow is significant in this piece. So current year also we improved this number, which was last year this number has been improved, which was last year 0.6. Current year we are able to improve it to 0.8. So we believe as we move forward, this number will continue to improve given the various levers available.
Okay. I have some more questions. I'll get back in the queue. Thank you, sir.
Surely, please.
Thank you. Before we take the next question, a reminder to all participants, you may press star and 1 to ask question. The next question is from the line of Abhishek Jain from Orient Capital. Please go ahead.
Sir, thank you for taking my question. Sir, I've just started looking at our bank right now. I just want to understand what will be the impact of recently farmer crisis or the farmer resolution, farmer impact on our business, because especially in the states like Haryana, is there any impact on our recoveries, or is there in our credit growth?
If we look into the present farmer protest, and if we look into the various asks made by the farmer community and the level of discussion between the farmers and the central or state government, this is typically more to do with the MSP and who shall be procuring the MSP crop. We being a lender and a processor of the transaction for our borrowers, for our customers, whether the processing is done or procurement is done by the state government or by the private authorities or the private corporates, the flow of the money, we are being part of all the channels, the flow of money will continue to remain the same. So we are not seeing any impact because of that particular aspect. Point number 2. If we look into this farmer protest, which is, I believe, from the farmer protest which we seen a couple of years back, this is much more reduced shape and scale. Even if look into that particular period and have look into the impact of that particular protest on our balance sheet, whether we took into from the perspective of the growth rate or from the credit quality rate, credit quality cost pricing. So we will see, you can see there is no impact of the same. Yes, we believe this, we strongly as a corporate believe this thing should settle quickly. But presently we are not seeing any significant impact on it, on our balance sheet and the book. And we are able to maintain the similar type of recovery proceedings even during this particular protest period, historically also, and during this particular protest.
Okay, just for my bookkeeping side, sir, can you tell me the number of branches we have added recently and how much we want to add going forward? And what is the target cost to income ratio which we are targeting in next 2 years?
So typically, we are presently having 177 branches spread over 5 states and 1 union territory of Chandigarh. Post the growth capital pouring in, we are intending to scale up our branch expansion by adding 25 plus branches, and we want to cross our branch count by end of this year from 200 plus. So that is what we are targeting for, and within this we want to open majority of the branches out of the Punjab. So increase our business from out of Punjab, and we will continue to penetrate in our new geography, in the existing markets also. Our branch expansion will be combination of adding the contiguous states, entering into the new geographies, and penetrating in the existing markets. So this is what we are looking for. As far as the cost income ratio is concerned, we discussed that our presently cost to ratio is around 2.95% on the average asset book. We believe, given on one side we have a huge advantage which is pouring in from our scale and matured branches percentage increase. A branch typically take 15 months to 21 months for the break even, and post longevity of 3 years, it get productive and high productive post completion of the 5 years. Now our matured branches, which is 5-year plus branches, are getting in a majority state. So with that thing is pouring in. So we are seeing a good benefit pouring in from that side, and then we will be adding few branches, which is typically on the base of 177, say 25 to 30 odd branches, which is typically 12 to 15% of the branches. So we believe that the benefit of pouring in from the matured branches plus scaling up will be better. So we see for the current year and being in a growth period, the credit cost of OPEX ratio will remain in the range bound around the current year levels.
Sir, one question. Hello.
Please. Please go ahead.
Am I audible? Yes, sir. Sir, can you throw some light on the corporate and consumer loans, which is these are the 2 segments where we have seen very healthy growth, constitute 17% of our book right now. How you see it going forward?
Our corporate loan segment, which is typically more a lending to the NBFC, which was 8% in FY23, has been 9% in FY24. And our consumption lending, which was 7% in FY23, is now constituting 8% of the present book. Let me clarify. Our consumption lending is typically to the clients who are availing over mortgage, MSME, or agri or any other banking relation with us, as their second, third, or fourth product selling or upselling opportunities. We being an organization who believe in a holistic product suite and meeting care of all the financial needs of the clients. So this is another hooks which is coming up with the existing client base. Rather than it is not a start point, it is the additional hook to the existing customer, which sits in a consumption lending. So these 2 books, we believe with the matured branches increasing, our hooks will have a more potent to improve it further. And in the corporate lending, which is presently constituting 9% of the book, against 8% a year back. So we want to keep it in the range bound manner only.
Thank you, sir. I have few more questions. If I have, I'll be in queue. I'm right now in queue, sir. Thank you.
Yeah, please.
Thank you. The next question is from the line of Shripal Doshi from Equirus. Please go ahead.
Hi, sir. Good morning. Thank you for giving me the opportunity. So my question was pertaining to yields and margins. So what is it that is leading to dropping yields? Like, can we calculate it on the book that the yields have dropped on sequential basis? So while as you are alluding that margins could be supported by CD ratio and higher liquidity. But on the yield side, what is it that is leading to a drop?
Surely. The drop in the spread is primarily driven by the interest rates, rising interest rate, which has put pressure on the industry as a whole because of increase in the cost of deposit. The impact is particularly immediate on the deposit side, where we as a banker have to offer higher interest rates to attract the funds. While the effect on the loan is delayed, as existing loan will continue at the lower price also. Now, if we look into the statistically, during FY24, our deposit rate remain almost at the same level throughout that over beginning of the year. At the end of the year, our highest rate of deposit retail was around 7.6 to 7.55 to 7.65. At the end of the year also it is 7.55 to 7.65. And if we look into the MCLR, we increased the MCLR by 35 basic points during FY24, out of which 20 basic point increase in the Q4 FY24. Ours being 60 to 62% floating rate book, which consists of 80% MCLR linked. Now we believe around over 40%, 35 to 40% of the book will be restarting repricing in Q1 only of FY25. So which will be giving us a benefit as we move forward. So which make us more confident of retaining the interest margins. Historically also, if we look into across the various interest rate cycles, over the last 3-4 years, if we look into our interest margins, it remain in the range of 5.5 to 5.9. Here my interest margin perspective is the difference between yield on advances and the cost of deposit. So, which giving us a confidence that we will be able to maintain our interest margins and improving the NIMs.
Got it. Sir, but is it when we are entering the new state, are we seeing the pricing being relatively low than our pricing for the products in the state of Punjab?
As per our present experience, since we look into the present market dynamics and the present in market rates, we are not facing some challenges, and we are finding similar type of interest rates rather in few of the geographies. The opportunity to increase yield on advances available.
Okay, got it. The second question was pertaining to non-interest income. So I think to one of the participants you were highlighting that that is something that we are working towards from improving from 0.8% to a relatively higher level. So what initiatives have we taken to boost the non-interest income or the fee income? Like even on the cross-sell opportunity, what initiatives have we taken? If you can highlight a few.
So typically, if we look into the non-interest income, non-interest income, over this interest income typically consisting of, if you look into this, which will give you a good color, what sort of the income it is. This other income is primarily consisting of our commission exchange and brokerages, which is linked to our advance book, our liability customer, banca commission, which constituting 63 crore out of the 68 crore which is out of the year. And out of this, remaining 4 crore is in shape of our 82 business profits. So typically purely a stable other income, rather it is not having any lumpy other income. Given that our matured branches percentile is increasing, plus our average ticket size of our saving bank account is 40,000 plus if we look into our continued opportunity to expand our credit given over the levers which we discussed over the call earlier, and our matured branches percentile increasing, which is giving us an opportunity to, which I call it a deepening of the existing customer base, with the customer base crossing already 7 lakhs. So which I believe giving us an opportunity to review and have expansion in this particular piece. And if we look, this which has started pouring the result in the current period also, which accordingly over this income has improved from 0.6 to 0.8. So these various levers which are available in this piece, with making us confident with our all product in place, with good partners in relationship being started, already being in place. So which is giving us a confidence that this is a one growth lever available for our ROTA and the PAT expansion.
Sir, but have we changed the KRAs of our employees to push the cross-sell? Have we taken any those sort of initiatives? While I understand that branch expansion would help us in onboarding new customers and so forth, but on the KRAs of our employees or on our approach on cross-sell, have we taken any of those measures so far?
Yeah, that measure has already been taken over the last years only, and we are refining it with each passing period.
Got it, sir. So the third question was on the quarterly trend that you have highlighted in another slide, wherein you've shown how growth tends to be a little volatile on the quarterly basis. So just wanted to get some sense that if you could give a trend on asset quality as well as on loan growth side on a quarterly basis for us. So for example, 1Q tends to be strong, 2Q tends to be strong, 3Q tends to be soft. So if you could just give us some sense on that side, that the slippages tends to be higher in 3Q, for example. So that will just give us a color on how the year plans happens for us.
We being a Suru specialist, that is a semi-urban and rural area specialist, with over 74% of the branches are Suru branches. So being Suru, the Suru has its own way. If you look into our historical trends, you will find our Q1 will be heavy on deposit growth, Q2 being heavy on our advance growth, Q3 being heavy on our deposit growth, Q4 being over heavy on the advance growth. So yes, we are working, so we are adding more and more of the urban branches to minimize this particular, you can say the quarterly split change. But just we can believe that Q1 being the deposit heavy, Q2 being the advance heavy, Q3 being the deposit heavy, Q4 being the advance heavy centers. From that what we believe, and that we are working to align it as we are moving ahead by adding more and more of the urban and metropolitan centers. Saying all this, so I believe on the asset quality side, the impact is that I see, if you give me our arsenal, even I look into the industry number, always we as a bankers put additional efforts at the end of each of the half year. So the efforts for the April, every recovery effort takes some time. So I always believe we will find the optimum results in September and March for all the period in our asset qualities.
Got it. So last question was on loan growth guidance. What is it that we expect, for FY2025-26 on the loan growth side?
So as we discussed earlier, what we are anticipating, we are looking for a growth for FY25, a growth of 22 to 24% on the advance book side. And going forward also, we want to look to increase our loan growth on a CAGR of 22 to 25% over next 3 to 5 years.
Got it. So just a follow-up here. I mean, given our size and the geography that we operate and we have a diversified product portfolio as well, what constraints us on loan growth side? I mean, 20 to 24% on a size of 600 crore. So what is it that keeps us at that level? Like, if you could throw some light on that.
Typically, the growth will be coming from the two sides. One will be sweating the existing infrastructure, and second will be building up the new capacity. So as we discussed earlier, we have ramping up our capacity building, which is, we call it a branch expansion. So accordingly, current year we are targeting 22 to 24% growth, and over the periods to come, we believe our growth rate will be keep on accelerating as we will be keep on adding more branches to our kitty, and our capacity expansion will be keep on happening.
Got it, sir. Thank you, sir, and good luck for the next quarter.
Yeah, thank you.
Thank you. The next question is from the line of Pritesh from DAM Capital. Please go ahead.
Hi, sir. Good morning. A couple of questions. Sir, this quarter, if you look at, there has been a little bit of higher reliance on bulk deposits, and our CASA plus retail TDs is slightly lower, though it's not off from trend, but few quarters it has been coming down from 98, it has come to now 92. So what is the sense on this? Why are we slightly increasing bulk deposits, and how do you see the cost of funds going ahead? So that was my question.
Pritesh, just one clarification, one update. I believe the current quarter there is no increase in the bulk deposit. Bulk deposit percentage for Q3 end and Q4 end are almost static, or rather I believe the bulk deposit is slightly reduced from Q3 to Q4. So that is my first clarification. Point number two, as far as the trend on the cost of deposit is concerned, as we discussed, we being seen a upward interest rate regime which necessitating increase in the cost of deposit immediately by offering a high rate of interest. So accordingly, cost of deposit increase has come immediately, which has poured in the shape of the deposit cost. So now, as I discussed earlier, just for the sake of repetition, our offered rate on retail deposit is now constant over last for a while, say 6 months to 9 months. That is the almost similar rates. So with that thing inside, we believe the rate of deposit, cost of deposit is getting optimized. So we are not looking for a significant upswing from the present level, or and we believe in the interest rate environment being stable. So we will looking that the cost of deposit will be stabilizing around this particular level. But on the side of the asset, given we increase the MCLR by 35 basic points in FY24, out of this 20 basic point increase in Q4 FY24. With 63% being the floating rate assets, out of which around 35 to 40% are getting repriced in Q1 only. So we can sense a good progress for the FY25 on that side, which will help us in maintaining the similar interest margin, and with an expansion in the CD ratio, expansion in the NIM is being anticipated. That is about the cost on the interest rate cycle side and overview and the our trajectory. And if we look into the CASA trajectory, if we look into the CASA, if we look into the industry-like CASA, industry-wise CASA, we see a lot of diving back down. We being a retail franchise with the fruit on the ground, having a strong branch presence, having a strong customer connect, we are able to retain this trend. If we look into our CASA number, if you slice it further and divide it with our deposit, which is retail deposit, you will find still our retail CASA deposit is 41% plus, which is almost a similar level which was a year back. So on a optically, you were finding it 38%, which is around 39% a quarter back, almost flattened. And if you look into the industry, the type of the loss CASA have, because you have the right numbers available. So we believe, given our practice of a deep penetration, given our practice of a retail franchise, given our practice of a target customer segment of middle income group and their holistic bank suite, we are able to retain this number. And we are confident, yes, we will go with the industry trend. So we believe but we are confident to beat the industry or to have better numbers than what whole of the industry is depicting.
Got it, sir. So just one follow-up on the yields perspective. If you can mention, will this yield benefit also come on our agri book, given that what we know is that agri is somewhat fixed book, and if your book will see that repricing? And second is in the yields perspective only, as the mix changes, what kind of a yield change also you can see in your book going forward?
Pritesh, as far as the agri piece is concerned, agri piece is typically annual to biannual price reset asset. So typically MCLR and increased benefit will be also pouring in that particular book. And as far as we going forward our growth drivers for the current fiscal will continue to be mortgage, MSME and agri. The similar three drivers which we are chasing up to now, depending upon the geography, that these drivers will depend upon the geography. So with these three drivers going ahead, we believe that we will be able to retain, we will be able to improve rather yield on advances in the current year from FY24. So that is what we believe, and that is where we are targeting to be.
Got it. And last question from my side is on the staff OpEx. This quarter it was slightly soft. Given that we are doing a little bit of expansion, do we see our OpEx growth a little bit higher than the balance sheet growth, or do we see that we could see some benign OpEx in FY25?
As far as Pratish, I will prefer that our overall OpEx ratio, given staff cost and other staff cost, that is the split which we are talking about, is we are typically maintaining 55 to 60% in one of the segment, being 40 to 45% being other segment. Our typically OpEx ratio is remain in the range of 2.9 to 2.95. That is a broader range if you see over the last 4 years. So we believe over this ratio will remain around the similar level given our accelerated branch expansion philosophy also. Within this, staff cost is a relative which dependent upon how the market plays. But if we look into our philosophy, our readiness, we have our business sourcing and servicing it through the branch channel, underwriting is done by our regional cluster and head office level. So we have the regional cluster and head office level readiness to support up to 225 to 250 branches from 177 presently. So we believe in the current fiscal, I'm not looking forward any significant change which I require to do in our middle management to higher middle management. The expansion will be at the branch level, so which we believe will be continuing the similar trend line. So I'm not anticipating any significant surprise from the staff cost current year.
Got it, sir. Thank you for those answers. Thank you. All the best.
Thank you. The next question is from the line of Franklin Morris from Equitance Wealth Advisors. Please go ahead.
Yeah, sir. Thanks for taking my question. Sir, if we move towards the ECL framework, I wanted to understand what would be the provisions required.
If we look into the ECL framework, ECL is typically work upon the LGDs. And given the present write-offs and the present way we have to do a compromise, which is very insignificant, and also stepping up, that is the over PCR requirement given the step-up choices, that is the SMA 1 and 2. Being these numbers remaining in controlled, the numbers are available in our presentations. So I'm not seeing any significant impact on the ECL. So I believe there will be some significant benefit on the ECL. There will be not any significant change from what we are in the present accounting structure.
So what would be our SMA 0 exposure?
So we typically change SMA 30 plus. Given our EMI due dates at 11, 21, 23rd, these dates, and with the cash flow coming on around the 1st or 3rd of the month. So typically, if we look into SMA 1 and 2 to put together, this is 4.5. SMA 0 being 0 to 30 days is one segment, we being using our own accounts for recovery, over 90% plus recovery through SI route. So typically our internal matrix, our KPI is typically SMA 1 and 2 together, which is 4.5% cumulative for the bank portfolio as a whole.
Okay. I just wanted to understand because in the ECL framework, then SMA 0 as well would be considered. And we are having a provision of about 50% with that 4.5. So just wanted to understand.
As far as the last calculation which we have done on the ECL, we are finding a positive impact on the reduced ECL provision requirement as per the performer.
Oh, okay. And sir, in terms of universal bank license, what is our thought process?
As Mr. Samra said, yes, that is one of the important milestone which comes in the banking landscape, and goods against the positive energy to organization like us, who are a well-diversified asset book. If we look into that particular guidelines, we have complied with all the requirements except net NPA, which is prescribed to be 1%. We believe that given our plan going ahead, keeping in view the macroeconomic factors which are prevailing as on date, we intend to achieve that over next 12 to 18 months period. So accordingly, we will be looking forward to the universal bank as guided by our board and the views taken by the board of directors. So that is what we believe. What I just believe, given over this is giving a good breakthrough and good foresight to the SFBs like us. Saying all this, but I believe the present SFB structure giving us a huge opportunity to scale and sustainable, profitable growth.
Yeah, sir. In terms of diversification, we are largely present in Punjab. So would that not be a hindrance in terms of getting a universal license?
Diversification, to the extent we understand, is with the sectors. We are a purely diversified play with the assets being diversified across various products and also being a secured franchise. With agriculture 37, with mortgage 26, with MSME 19, with the corporate 9, with the consumption 8. So we are fairly diversified in our advance book.
Fair enough, sir. Congrats and thanks a lot.
Thank you.
Thank you. The next question is from the line of Anand Mundra from My Temple Capital. Please go ahead.
Thank you for the opportunity again. So just wanted to understand what is the underlying security that we have in our agri loans portfolio and the MSME and trading loans portfolio?
So typically we have the two line of securities. It just gives you the color about the whole of the portfolio. Over 86% of the portfolio, we have it, of the total portfolio, we have a collateral in the shape of immovable. That is in the shape of the land, building, or the office build space, or bank-owned FTR. So over total portfolio, out of the 186%, we have a collateral, which is tangible collateral in addition to the primary. And now coming to your specific question, on MSME as well as retail, we have a two line of securities. One, primary security in the shape of, depending upon the nature of the facility we granted. I am presuming you are talking about the working capital. If I taking a working capital facility, in addition to the charge on the current assets, we take a collateral in the shape of his residential house or the office building. That is, we do all collateralized based lending only. We are not a no collateral based lender. We take for the immovable property. And similarly for the agri, we typically, in addition to the farm produce, we have a collateral in the shape of the land. And just to highlight, we value that land on a collector rate, that is the government rate, not the market price.
Okay, and is there no restrictions on enforcing agricultural land as security under Surface Act?
The agricultural land and the property are typically is enforceable under the recovery proceedings. SARFAESI, this agricultural land is not being covered presently under SARFAESI for a quick resolution, but given over LTV, we typically look for the 50% LTV valued at the collector rate, plus lots of cushions we have put, which help us in maintaining the right asset quality. We've been lender in the agriculture from now more than 24 years and seen the various cycles. And we are able to effectively recover, which demonstrating our understanding of this segment and this geography well.
Okay. And so my last question was, have we reported any fraud losses like in our history? If you can just give some color on this.
The thing is that the frauds are getting common in the banking space. Or historically till date, just we may have reported a couple of fraud cases, though even a few in the periods also. So just there are some reputation of the fraud cases also. But the cases, as per our opinions, as per the expert opinions, are presently covered under Fidelity Insurances. So we will be invoking the Fidelity Insurances also, which is available with us as an organization.
Okay, so anything that we've that any fraud losses that have happened in the recent past, if you can highlight, and what was the reason? Like any steps that we've taken after that to improve our internal processes or something?
So typically, there was a fraud case which happened was done that with the cognizance, with the involvement of one of the revenue authorities. Someone has sold their land which is mortgaged with us without taking NOC from us. We have taken a cognizance of it, made a FIR, filing a 420. So these are the procedural things which keep on happening. But there are no such a large number of frauds which have happened and not a material values. So we have keep on taking right steps in the right direction to ensure non-repetition and minimal loss to the organization.
Okay. Thank you, sir. That's it from my end.
Yeah, thank you.
Thank you. The next question is from the line of Chinmay from Prescient Capital. Please go ahead.
Hello, sir. Just a small request from our side. Going ahead, could you include a detailed NPA schedule in your quarterly presentations? So basically, opening balance additions, recoveries, technical write-offs. Typically, banks provide that. Yeah.
Surely we can. I request my credit and my finance team to take note of it, so we can certainly look into and evaluate the same.
Great. Thank you so much.
But as a matter of fact, I just sharing, we are presently current FY24, we are 2.4% slippage and 2.1% upgrade and recovery number.
Got it, sir. Got it. Thank you.
Standard asset.
Yeah.
Thank you. The next question is from the line of Ashok Shah from LFC Securities. Please go ahead.
Thanks for taking my questions. Sir, congratulations to you and your team for giving a very good result. Sir, regarding the dividend distribution, which is just 4% of the profit we have made during the year. So is it as per the RBI guidelines or RBI permission, or it will increase in future years, because percentage of the dividend distribution is only 4% of the profit?
So as this is a decision of my board, so being a growth-oriented organization, we being in a growth engine-based organization, so which will necessitating to sow a seed for our future growth. So this is as part of that strategy that we continue to sow a seed for our future growth and keep on keeping the money with us. But along with this, that's ensuring some cash flow for the investor. So the dividend, so the fine balance is being created between dividend payout and the retention. So we being in a growth phase of the entity, which is necessitating to organization like us to have the right capital base, which can support our future growth, which act as a compounder for the stakeholders. So keeping that in mind, this dividend is being decided by the board members, but being a strategic decision, so board members' decision, there is a good deliberations happen on the subject, and accordingly decision matrix is being arrived at. But just noted your point, and we will accordingly look into the same. If so, that's the way how we work about it.
So there was no restriction from the RBI, no, to increase the dividend or something like that. It was.
So there is a limitation on the RBI on the payout ratio, where we are well below that payout ratio.
Okay. And secondly, sir, do we expect after the IPO money is coming in at least a 20% growth over the next 2 to 3 years?
We just beginning of the call, we believe that on the advanced side, we want to grow 22 to 24 in the current year. And so there will be acceleration in the ROTA also from 1.3 to 1.4 type what we are targeting for. So with these two numbers bisected, yes, we are putting our best efforts to accelerate the growth trajectory.
During the current year, how many new branches we plan to open?
We discussed in the beginning also, we are presently 177 branches. We intend to cross 200 plus during the current year.
Thank you, sir. Thank you. That's all from my side, and very best wishes for the current year.
Thank you. Thank you, sir.
Thank you. Ladies and gentlemen, as that was the last question for the day, I now hand the conference over to Mr. Sarvjit Samra for closing comments.
Thank you everyone for joining this call, and we look forward for your valued support, and definitely we'll meet with the next quarterly results. Thank you.
Thank you. On behalf of Capital Small Finance Bank Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.